Yusef, thank you very much indeed. It's a great pleasure being in this wonderful place. And I look out over Florence and it's just extraordinarily beautiful. And it's a great pleasure to attend this absolutely splendid conference. And it's been a fascinating morning. I must make a couple of apologies. First, the paper that I'm going to introduce is in proceeding, it's still being worked on, and many of the related data and charts and tables, which I will produce in time, are not actually there yet. But before I do that, I'm going to reveal a particular reason, which I think that Yusef probably does not know, why I am actually an appropriate person to be talking at this keynote speech. And that is because I'm a member of the Lehman family. My grandmother on my father's side was Hattie Lehman, who was one of Meyer Lehman's daughters. If you don't know who Meyer Lehman was, you obviously don't know that much about the Lehman family. And I would actually strongly suggest that if you get a chance, do go and see the Lehman trilogy, which is a magnificent play, written actually by an Italian whose name I've temporarily I've forgotten. And I'd just like to, for a moment, go away from my sort of prepared comments to say a couple of words about how the Lehman family, if I can speak for them, which I really can't, thinks about it, the Lehman brothers. In some ways, I think we're sorry about the name, because the Lehman family actually severed all its connections with the bank after Bobby Lehman ended his period as head of Lehman Brothers, and it got sold off to an American Express, and then this and that happened to it. And by the time the Lehman Brothers failed in 2008, there was neither any member of the Lehman family, as far as I'm aware, working in the bank, nor was there any, again, as far as I know, Lehman family money actually invested in the bank. So that the Lehman family was totally unconnected with the bank at the time of its failure. I would also like to take the opportunity of saying that the Lehman family has done a great deal more over history than simply found and run Lehman Brothers for a long period of time. Perhaps the sort of most glorious period of the Lehman family history was in the 1950s and 1960s, when not only Bobby was head of Lehman Brothers, but in many ways much more important, my great-uncle Herbert Lehman was senator from New York, and he was the main opponent of Joe McCarthy in the Senate. And another great-uncle was Irving Lehman, who at that time was Chief Justice of the New York Supreme Court. And I think it must be a remarkably rare occurrence for two brothers to be simultaneously a senator and Chief Justice of a US state. The Lehman family feel that we have much to be proud of, and it is in many ways a pity that the name is connected with the failure for which the family takes no responsibility whatsoever. However, that's by the way. I normally do not make my connection with the Lehman family, don't make anything of it, because it has nothing to do with my own work as a economist. And so let me get on with the actual stuff that I'm going to present. Now, what I'm going to talk about is as follows. First of all, I'm going to say that limited liability equity finance entails massive moral hazard. It is extraordinary in my mind that the moral hazard of limited liability equity finance has not become front and central, while many other forms of moral hazard of various forms of mutual insurance, deposit insurance, all of which have much less effect on moral hazard than limited liability equity finance, have tended to be much more emphasized. The limited liability equity finance has been one of the factors leading to low investment ratios over the decade since 2008. And as a result, there's been a surplus for non-financial corporate sector. Partly as a result, debt ratios have risen very sharply, mostly, and our economies are very close to, or actually in, a debt trap. I'm going to ask how we can escape from that debt trap, which will be difficult. And I think that the need that we have is to rebalance our economies towards equity finance, away from debt finance. That requires fiscal rebalancing between debt and equity. At the moment, debt has very considerable fiscal advantages relative to equity finance. And as in another paper, Rosa Lastra and I argue, it would be desirable to adopt a two-tier equity structure between the outsiders, who have no power to influence the decision that the public corporation actually has, the outsiders retaining limited liability, and the insiders having multiple, possibly in a very rare case, perhaps one case, perhaps the CEO, even unlimited liability. Now, this diagram, and I apologize for the amateurish nature of it all, where the constant line represents the return to the shareholder with corporate profitability on the horizontal line, and the 0 point showing that when corporate profitability is 0, the shareholders get 0, but as the corporation runs into losses, they still get 0. And even when it becomes bankrupt, they get 0. So it has this particular shape, which, as has often been set out, is equivalent to having a call option on the assets of the corporation. And as you all know, if you have a return structure of this shape, it leads to a desire for volatility. Because if you have, say, an absolutely safe return a little bit to the right of 0, and you have, for the shareholder, an equivalent chance, 50-50 chance of either a significantly bigger return or a sufficiently smaller return to the corporation, you will take the riskier one. You're bound to, because it makes you in a much stronger position. So that inevitably the equity shareholders are going to push corporates into taking greater risk than is socially desirable, because it's in their interests. And risky corporates, like for example Northern Rock, was the darling of the London Stock Exchange 6 months before it went belly up, because it was highly leveraged and effectively took a lot of risks. Now, this sort of tendency of limited liability to encourage risk-taking is somewhat attenuated by loss aversion. But when you can have, as most people do, massive diversification, so that your holdings are only to a small extent in any one equity, it means that loss aversion is effectively limited, because you've got a chance of a very big upside, and your potential loss is only the small amount of your total portfolio that you hold in that particular set of equities. Now, the pressure to take on greater excessive social risk as a result of limited liability was held in check to some considerable extent by the fact that the corporate decisions were not in practice made by the equity shareholders. They were made by the managers of the company. And until about sort of 10, 12 years ago, maybe a bit longer, no, it was longer, it was under Bill Clinton, the managers of a public corporation were largely paid in the form of a salary, and they also took advantage of their position to have a number of, what shall we say, managerial perks, which led to the drive to align managerial incentives with the incentives of shareholders. You will remember that. And as a result, there was a switch in remuneration from it being a fixed salary plus other factors, of which, of course, reputation was one, to one in which there was a bonus culture, and the bonus was generally paid in a form of equity, deferred equity, and all of that. And that meant that the managers' incentives were aligned with shareholders, probably one of the most unfortunate sort of decisions that was pushed forward by finance economists of various kinds, and inevitably then meant that the managers who usually had an expected relatively short life at the top of their companies, overwhelming desire became to maximize the short-run equity valuation of the companies which they managed, which was indeed what the shareholders wanted them to do. Now, what this led to was a reduction in longer-term investment, and if you take the period since 2008, for corporates it's been a really quite extraordinarily favorable conjunction. The share of profits in national income has been higher than virtually ever in history. It's been terribly low, extraordinarily low, exceptionally low interest rates, both real and nominal, and equity valuations have been exceedingly high. Tobin's Q has been very high. Nevertheless, investment ratios have been very low in advanced countries. Partly this was due to a shift of investment to Asia and Eastern Europe, and even in China, the extraordinarily high investment ratio was more than balanced by the very high personal sector savings ratio, a one-child policy. I'm just going to take a slight digression. It was a fascinating article I read the other day by, I think, a couple of Chinese economists asking about what happened or has happened to the old in China as a result of the very sharply declining birth rate, which incidentally preceded the one-child policy, because the birth rate has gone absolutely way down. The result of that has actually been that the old in China now have considerably more financial assets because they didn't have to spend so much on bringing up their children. They're also physically healthier because they're better off. But, and this is quite a big but, the family linkages have sharply declined. One reason for that is the one-child policy meant that the child was much better educated and much more mobile in the labor force, and frequently sort of went away, emigrated to the factories in the east of China, on the coastline. The result is that one grandchild finds it very difficult to actually visit four grandparents. So that the family nexus in China is declining, with the result that the mental health of the aged in China has declined very sharply, and the suicide rate of those over 65 has gone up by a factor of about 3 or 4. I know it has just jumped, so that you have to sort of balance, if you like, physical well-being with mental well-being. Anyhow, and that was a digression. One of the issues that what we do need to ask is why has investment ratios in the advanced economies been so very low? And there are quite a number of reasons. One is that people argue there's been greater growing corporate monopolization. Next one is, it's all the knowledge economy, and, you need human capital, and you don't need much in the way of cement and steel in order to build software and all of that. Managerial incentives I've just effectively talked about, and here the argument goes, though it is challenged, that the managerial incentive is to maximize short-run equity valuations, and therefore if there is a long-run investment or research and development project which will not be seen to develop high returns until quite a lengthy period away, you don't do it unless you think the market will recognize its value. And the final one, again, is cheap labor. You don't invest in the US or the UK if it's much cheaper to do the investment in, shall we say, Poland or China. And that has kept down wages very sharply. The massive increase in labor supply available worldwide to entrepreneurs has broken the power of labor, has led to a complete collapse in the power and the existence of private sector trades unions. And if labor is so cheap, why invest rather than undertaking labor-intensive activities? You all know the relationship between wages and productivity, or real wages and productivity. And the argument goes that unless productivity grows, real wages won't grow. But the relationship works in the other direction as well. If real wages are so low, it's just not worthwhile investing in order to try and substitute labor and having capital instead. So one of the reasons why productivity has been growing so slowly over the last 10 years has been because labor has been so cheap. It hasn't been necessary in order to maintain the very high profitability of the corporates to undertake much in the way of labor-saving investment. Now that real wages are beginning to rise again, I think that there is a good likelihood that productivity will rise with it. Although labor, because it has lost its power, and because it's been so subdued over the last decade, 2 or 3 decades, the natural rate of unemployment has undoubtedly declined. So the easiest way to raise the return on equity in the short run is buybacks. And there was an editorial in the FT the other day about this. And the amount of buybacks has been enormous. So that the corporates have been raising a great deal of debt. Only a relatively little amount of that, comparatively, has gone into fixed investment. A proportionately much greater share than in the past has gone into buybacks. And I talked about the incentive from short-termism to reduce longer-term investment in R&D. The result has been that debt ratios have been rising sharply everywhere, with the exception, 3 exceptions, Germany, the banking sector where regulation has forced leverage down, and households in those countries which had a housing collapse during the great financial crisis. Now I'm going to show a couple of tables rather quickly, which are not up to date. And this was the change since Q4 2007. And this was actually the figures. I think these go up to the end of 2015. If you take up to the end of, go on 2 years and they'll be redder still. And if you look, the HH stands for households, NFC for non-financial corporations, PSC is just the private sector, it's the sum of the first 2 columns, government, and there you've got the total. So what you've got is that despite the great financial crisis being said to be a crisis of over-leveraging and over-indebtedness, what we've got generally is a much greater increase in debt than we had before. You can see how much Germany stands out as an exception of this. And again, you can see that the households The countries where the household indebtedness has gone down, at least up to 2015, the US, the UK, Spain, to a lesser extent Germany, were those which were hit by the great financial crisis, whereas countries like Austria, Canada, and Sweden, which did not have a banking crisis, the household mortgage indebtedness has rocketed up. Corporation debt has gone up. One of the problems here is that if the corporate sector is going to run a surplus, because it's not investing very much, and the households, as the baby boomers were coming up to retirement, is going to run a surplus because they need to finance their retirement. The private sector, by definition, is going to be in large surplus. That means that there is absolutely no alternative if you're going to have any kind of balance within your economy and not have a major continuing depression, for the government sector, the public sector, to go into very large and increasing deficit, into increasing debt. And it follows. And that is one of the reasons why the low investment ratio of the corporations is such a continuing problem. The increase in the debt, now this is slightly different. That chart was the first chart was the level. They were 2 years out of date. It was the change, the first chart. This is the level. And here you can see how the corporate debt in many emerging companies, particularly in Asia, has been massively increased, with China at the top. And that continues. The debt positions of our corporates, particularly in Asia, is really very considerable indeed. Now, that effectively has led us into something of a debt trap. And what has happened has been that the central banks, with encouragement from everybody else, has been running a very low, very expansionary policy with exceptionally low interest rates. And the purpose of that is, indeed it has to be, to encourage people to go into debt. And one of the problems has been is the going into debt, particularly in the corporate sector, has not been to buy fixed assets to invest, it's been to increase leverage. So we're in a very highly indebted level. So high is our indebted level that the central banks around the world do not dare to raise interest rates in any other way than glacially slowly. Because if they were to do anything else, given the extent of indebtedness, they would provoke almost immediately and almost assuredly another recession, financial crisis, which means that they can do nothing other than to keep interest rates at what historically is an extraordinarily low level. If interest rates remain at an extraordinarily low level, there is no incentive on anybody to do anything else than to go on borrowing. So that there's a problem is indebtedness worldwide, and it's not just governments, it's corporates as well, is in a very serious situation. Now, how do we get out of that? Now, the desirable way of getting out of a debt trap is to grow out of it. You are not going to be able to do that. When I mean you, I mean the sort of countries around the world. And the reason you are not going to be able to do that is nothing to do with productivity, which I think may, for some of the reasons I've been suggesting, recover. It's to do with demography. The world was in an extraordinarily fortunate position from about 1980 to about 2007, which was, of course, the greatest 27 years of economic development that the world has ever seen, in which world inequality declined, even though within countries, almost every country, income inequality increased. The the reason why it was such a favorable period was demography, which was that the birth rates were going way down, which meant there were very fewer young, and the fact that the expectation of life was increasing only led to an increase in the proportion of the old really fairly slowly. That's now changing dramatically. The baby boomers are reaching retirement, and the rate of growth of the workforce is going to slow down to virtually nothing in many countries, many continental European countries in particular, and China. The workforce is actually going to decline. The dependency ratio is going to rise dramatically, and the cost of looking after the old, both pensions and medical, is going to rise horribly. The projections, the fiscal projections on present policies, is that government deficits and debt is going to start skyrocketing unless tax rates go up very, very sharply. And growth, when demography is against you, you just virtually can't have growth. And most people think of Japan as being a country that has done relatively poorly over the last 10 years. That assumption is completely wrong. In Japan, the workforce has been declining at a rate of 1% per annum, while output has been rising at 1% per annum, which means that output per worker has been growing at 2% per annum, whereas output per worker in most of the rest of our countries has been growing very much less than that. Output per worker in the UK has hardly grown at all. So if you look at output per worker, you will see that Japan has been doing really very well indeed. And considering that the number of workers is going to, the number of workers in China is going to just start, it is declining already. So you can't have that much growth when your workforce is declining. It's just virtually impossible, unless you have a productivity miracle. And we will need every robot, every bit of technological ability we've got in order to try and raise growth. Well, you can try and reduce the debtor burden via inflation. Well, will the central banks allow it? Maybe the central banks will become less independent when interest rates have to start rising to deal with inflationary pressures. Central banks and ministers of finance have been the best of buddies over these last 25 to 30 years, since interest rates have been coming down and the debt burden hasn't yet started to hit, because the rise in the debt ratio has been more or less equally and exactly offset by the decline in interest rates, leaving the debt service burden, the debt service ratio, unchanged. And that is now going to change very sharply. And if central banks start raising inflation, a number of politicians, led by such as Trump, Erdogan, and others, will start to try and impinge on central bank independence. Renegotiation and restructuring. We've really got to look at Cyprus and Greece to see some of the difficulties of that, and default, well, we don't want that to happen. So the final way that I suggest that we could try and deal with the debt trap is to switch from debt to equity finance. But this requires a number of factors. The first thing that I think it requires is a fiscal level playing field. There's a very good study on taxation reform that Jim Mirrlees, the Nobel Prize winner. I shared supervision with Jim at Cambridge. He and I were exactly the same year. We were quite close together. He was a lovely man, and he managed a lovely study of taxation possibilities, in which the suggestion was that you equalize the tax implications on corporates of raising money by debt as a result of raising money through equity. And if you want to think more about how that should be done, can I suggest that you actually buy the Mirrlees book? I got a copy in my bag if anyone wants to do it. Now, the other one is that I think that we need to consider the adoption of a two-tier equity framework. Remember, debt has many tiers. You can have senior debt, you can have junior debt, you can have all kinds of debt with bells and whistles on. Now, it's not at all clear to me why, in principle, that should not be exactly the same for equity, that you could have different tiers of equity. And if I could, I'm just going to go back quickly to one of the, yeah, that one. One of the effects of limited liability is when a corporate runs into difficulties and when it runs into bankruptcy, the point of corporate bankruptcy. Because of limited liability, this enables the equity shareholders to shift risk to other partners, to their employees, to the other creditors of various kinds, including trade creditors, to taxpayers, and other members of society who get it indirectly. And many of these, of course, have no responsibility for the bad outcomes that has occurred for corporate profitability. And I think that much of the political anger, the political angle that accompanied the great financial crisis was not so much that anyone really wanted their banks to be shut. They didn't want, they weren't keen for Lehman Brothers to be shuttered or Northern Rock to be shut or any bank to be closed down. What I think got under their skin was that those who were responsible for the decisions, whether it was intentional or not, to take on the risk that led to these outcomes, seemed to get away with it without much in the way of a severe sanction. Whereas a lot of people who had their homes repossessed in the US, who were junior employees who got thrown out of a job, who were trade creditors or other creditors, lost really quite a lot of money. That the bankers, and particularly the bank managers, people like Fred Goodwin and Dick Fuld, appeared to be able to walk away with millions of dollars in their pockets. They considered trying to see if they could claw back Fred Goodwin's pension, and they decided it was sort of impossible to do that. So that the suggestion that in an accompanying paper that Rosa Lastra and I are trying to put together, we are arguing for a division between outsiders, who are defined as those who have really no power or inside information to influence or control the decisions that their corporation undertakes, retain limited liability. Because the argument that you do need outside equity capital in a world in which corporations are inevitably large remains unchallenged. But that you have insiders with multiple and at the extreme unlimited liability, so that they have a greater pecuniary sanction in the event of failure. And there's been quite a lot of prior examples of intermediate states of intermediate liability, which isn't either unlimited or limited. Equity shareholders in the US, bank shareholders had double liability. There were other occasions of double liability. One of the problems is how do you draw a distinction between insiders and outsiders? And that, I think, is a really quite serious problem. But nevertheless, I think that the argument that the incentive that limited liability provided to everyone gives for excessive social risk-taking, and also combined with short horizons, short-termism and a lack of investment, is fairly compelling, and that we actually do need to reconsider the structure of finance in order to have a different extent of liability for those who have responsibility for the decisions that corporates take. I would add a couple of extensions of that. I would try and apply exactly the same kind of sanction for failure to auditors and also to credit rating agencies. So that, for example, if there was an auditor of a company like, shall we say, Carillion, which goes bust within the year of its last audit, and the auditing company put up no warning flag, either directly or even a private warning to the regulator, then that audited company should have to pay back to the state every single penny that it earned from auditing that company, starting from the date at which it began auditing that company. And the same kind of attempt at sanction for credit rating agencies. Again, I would also like to try and make a change to the way that corporate fines are introduced. The moment if a corporate does something which is regarded as judicially wrong, shall we say BP Deepwater in the Gulf of Mexico, there is a levy that is imposed on the corporate as a whole, which effectively cuts down the corporate capital, and it has an immediate adverse effect on the ordinary outside shareholder. And the ordinary holder of BP had no more influence, knowledge, desire to play any part in the way Deepwater is run than you or I or anyone else. So that if we could have, if you like, a double tier or a different tier of shareholders, then I would try and ensure that any corporate fines for misdemeanors, judicial and wrongfulness, would be levied only on the, if you like, the insider shareholders, i.e. the managers, the board, the senior employees, those in the corporation who took down very large salaries and were therefore obviously playing a fairly important role in the operation of the corporation. And I think probably that's a good point to bring it to an end. So happy to take any questions if a minute or two.
Keynote speeches are sometimes not followed by question at all, they're just delivered. Sometimes there are questions. In fact, we have 3 minutes. So because of Keisha has taken the initiative very quickly, okay, first come, first serve. If you'd like to, otherwise we can stay without a question, or we could take just one.
Oh, actually, that reminds me. The suggestion that if you impose greater sanctions on management, that there'd be nobody prepared to be a bank manager. I think history clearly indicates that's totally untrue. Because remember, before the middle of the 19th century, virtually every banker was unlimited, and there was no shortage of bankers when there was unlimited liability. I just don't believe the argument that you wouldn't get. And if you were offered a chance to take a position of considerable power and influence, even if the sanctions were potentially fairly high, I think most people would still take it. It was said in New Zealand when they made effectively the directors responsible, legally responsible for, and subject to civil suit if anything went wrong in their bank. They said in New Zealand before they introduced it, no one would be prepared to be an executive or a non-executive director. It turned out to be absolute nonsense. It will always be said that there won't be bankers if you make sanctions for bad outcomes worse. I just don't believe that to be true.
Well, I mean, it's like the death penalty in a way. No, thank you very much, Art. I think it's better not to take any question because it's a debate which is at the heart I think it has come this morning already, and it's at the heart of reflection on the financial crisis. I think you've given us a broad picture with a broad economic picture with the main tenets about which to think, debt, responsibility, and I think, well, this is what we expected from a keynote speech.
But you didn't know I was a member of the Lehman family, did you?
Actually, I might, because my social historian background, and I like to look at genealogies, and I might have looked up at some stage, but I didn't remember it at all. No, so it's a good, it's well, I think a very good connection. So thank you very much. It's a shame you can't continue with us, but